central concepts of what we're going to be talking about today is BRRRR, the BRRRR process. And this right here is probably one of my favorite real estate books of all time. Buy, Rehab, Rent, Refinance, Repeat by David Greene. David Greene is a co-host of the Bigger Pockets podcast, which is, I believe, the #1 real estate podcast in the country, and just an indispensable tool for learning about investing in real estate for the first time. This book was really kind of what started it all for me. And back in 2021, I attempted this business model for the first time, with varying amounts of success, which we'll talk about, and certain lessons learned that now have contributed to this exciting new business model that we're doing this year. The reason why I bring up the BRRRR book specifically is because a lot of our conversation today is going to be inspired by some of the concepts in that book. Basically, one of the big things that happened over the course of the last couple of years is because of the prices of real estate going up substantially, and then suddenly, the Fed stomping on the brakes by increasing interest rates, it makes the BRRRR strategy fundamentally difficult to pull off successfully. So let's first kind of go over roughly what BRRRR is supposed to look like, and then we're going to talk about why in most parts of the country right now it doesn't work, and then we're going to talk about what we're doing differently that is kind of breathing new life into this business model. So what is BRRRR? Okay, so imagine that you're in a neighborhood where the average house costs about $100K, all right? Now you've managed to find a really good deal on a fixer-upper that is only $50K. And you look at it and you look at you kind of like tour it with some general contractors, and you tell yourself, or you figure out, okay, you know what? This is going to cost about $30K to fix it up. All right, so all in, so that's $80K to create a house that you hope is worth $100. Okay, all right, so let's assume that you're successful. By the way, this up here, just to kind of throw a few more like lingo terms at you, this is what we would call the ARV, the after renovation value. Okay, so you take this to the bank and you do a conventional loan on it to do a cash out refi. Technically it's your first time financing, but we still call it a refi, just colloquially. So you do a cash out refi, you tell the bank, hey listen, I've got a house that's worth $100K, I want to take 80% out of it. Of course that is $80K. Okay, and essentially you now have enough money to be able to start the process all over again. So that's what they mean by buy, renovate, you rent. So let's say in this situation, you rent it out for, $800 per month. That gives you enough income to be able to cover the cost of this loan. So the renter is paying for this loan, for this $80K, and now you're able to just repeat the process over and over and over again. All right, so that is essentially how BRRRR works. Sometimes this number over here can go up or down a little bit. Like let's say that you actually are able to pull out 85K. Well, that 5K is your profit, and it's the best kind of profit. It's profit that's not legally a profit. It's just a loan, so you don't owe any taxes on it. Pretty cool. And there are a bunch of different circumstances though that might lower what you're pulling out. Let's say you're only able to pull out 70%, which is very typical in today's market. So you only were able to pull out $70K. One of the things that we have run into, unfortunately, over the last couple of years is with prices going up. That's supposed to be a $, and also interest rates going up, it makes it so that, all this stuff, the numbers just keep getting lower and lower. Okay, long story short, what I in my first 2 deals that I did, that I tried to do this business model, I was really only able to get effectively about 50% loan to value. And that's for 2 reasons. One, because I was buying duplexes, and the duplexes were not being appraised at what I as a professional investor would consider to be their full value. Like, I know that investors buy based on the amount of income that the property brings in, not on comps of similar properties around it, right? I was doing these extremely high-end luxury duplexes that, were significantly increasing their rental value. But from the bank's perspective, they can't just look at a bunch of photos of like fancy kitchens and bathrooms and say, oh yeah, this is going to be worth $50,000 or $100,000 more. They were actually very reluctant to give me those higher valuations. And so essentially, between that and the fact that the loan to value ratios were getting smaller, I really only ended up taking out about 50. And of course, if I'm only pulling out, 50K here, then it's really not, like I can really only do this a couple times before I run out of money. So, ultimately I just started thinking, and then, not to mention the fact that prices keep going up. Like, in practice, this deal here, this wonderful magic $50,000 house, the prices we're actually seeing out there in the real world now are actually closer to, let's see what I write that, about 60 to 80K. So you can see now we're sitting at a range where we're making almost no profit to a little bit of a loss. And there's kind of a colloquial term for this in real estate. We call this chasing dumb money. Because essentially what's going on is there's a bunch of people flooding the market who, are just driving up the competition so much, driving up the prices so much, that they're willing to make, very little or even no profit, just to get in the game, just to own something, because, maybe they're looking at it as an opportunity to, maybe they're a contractor and they're just basically paying themselves to do all the renovation work. Or, maybe they intend to live in it themselves for a while. So, in that circumstance, we're much more likely to see, these higher rates or these higher prices, even for properties that are objectively terrible properties. So, this presents a lot of problems for the professional investor. And for the first couple months of this year, I was really struggling to find a good deal for you guys. I had started out in January. I wanted to do fix and flips. I wanted to get money in and out quickly and, kind of multiply that money faster over time. And, and I honestly perfectly, would have been perfectly happy doing that until I met a new business partner, Dulce Garcia, just this wonderful, incredibly talented, brilliant, hardworking woman who discovered a business model that is, I think, one of the best. I know I'm kind of like, going to be saying a big statement here. I mean, I might be overselling it, but I think it's one of the best investment strategies in the entire country right now. Mainly because it's one of the only strategies I've seen where BRRRR can actually work. In order to understand what Dulce has been doing, we're going to take a step back for a second and look at the world from a bank's perspective. Banks are all about managing risk. And so for them, they want to know at any given time, if I'm going to lend out this money, how easy is it going to be for me to get my money back if something bad happens? Okay? So banks take a very conservative approach to how they appraise the properties that they put loans on. And then they only lend an amount of money that they are basically very certain that they can get at least that amount of money back if they have to foreclose on the house and sell it. Okay. If you are if you're getting the loan based on your personal income, that makes things a lot easier for them. If you are somebody that makes a lot of income and it's very consistent, reliable, and let's say you got a big, like, mid to high six-figure salary from a big corporation, banks will do loans with you all day for this. And I do have some friends who are in basically a circumstance where, if you've got a good W-2 tech job from Google or Facebook or something like that, banks love you. And so, this is a great strategy because you're going to get really inexpensive loans with a very high loan to value, and you can have them all, in fact, be qualified as your kind of your personal conventional loans for your primary and secondary residences. And the rates on that are a lot better because those sell on the secondary market. Maybe I'm getting too complicated here, but just to kind of demonstrate, so like on one end of the spectrum, like that's what banks really love and what they're going to give the best rates for and basically the most money for. On the other end of the spectrum are people who are like real estate agents and professional investors who have very inconsistent income, who maybe have very high business expenses and don't claim that much income on their taxes. I'm just talking in general about lots of people, and this isn't directly about myself. And so banks don't really like that. And and as I said earlier, when they look at a 2 to 4 unit property, this still falls within what they would call residential loans. When you're at 5 and up, it is a commercial loan at that point. Then you're just sort of in a completely different ballgame. But for your little 2 to 4 units, they're still willing to kind of take a shot and make it work, but it just might be more expensive. The loan to value might be lower or even substantially lower, and the interest rates might be higher. I'll tell you, so I had 2 2-unit properties, and at the kind of end of 2022, I refinanced one at, I think it was 8.75% interest. And then towards the end of 2023, I refinanced another one at, I think it was about 8.25% or 8.5% interest. So, essentially the same. And and that you'll notice that's quite a bit higher than what a conventional loan would be for a primary residence. On average, it's about 2 to 2.5% higher. So that makes things really difficult in an environment where it's hard to find cap rates that are high enough to justify it. So I'm just going to write the number. I'm just going to write cap rate here, and we're going to write net operating income over price. I do have a great video on YouTube that explains this in greater detail, but long story short, cap rate is basically just a percentage of like how much money in rent do you collect every year relative to the price. On average, that number in America is about 6%. Okay, so in other words, the amount of profit that you bring in every year divided by the purchase price of the property is usually about 6%. In Southern California, it can get as low as 2 to 4%. Which of course is much below what the mortgage would cost for that property, and people are willing to do that because of just sort of like prestige ownership in Southern California. So like being able to own something in Beverly Hills or along the beach, people are just willing to essentially make no sort of like cash flow on that because they know that in the long run it's going to appreciate in value. All right, so in situations where the cap rate the interest rate right now is still sitting around 7%. Okay. So in situations where the cap rate is significantly, below that number, it means that you're going to have trouble paying for your loans. Assuming it's just like a cash flow. Like if it's a real estate investment that you're buying like for the cash flow, then this situation puts you in trouble. All right, so, there's a rule in a lot of real estate investment circles that they call the 1% rule. And, professional, like serious commercial investors don't use this term because it's a little bit imprecise. But basically what the 1% rule says is if I'm buying a house for $100K, it needs to generate at least $1K per month in rent. Okay, this is just like, you can kind of tell it's a lot less sophisticated than looking at what cap rate is. It's really just trying to say, all right, my gross rent, is this even worth looking at? And the issue with the 1% rule is it really, even when the economy is normal, it only applies in, half the markets in America. Pretty much any market that is, very urbanized, most of the markets that are very urbanized are, there's just too much competition. It drives the purchase price up, and relative to rents, and so so even in the best of times, this is a difficult rule to follow, and right now it's almost impossible. What if I told you that we are actually going to beat this number? I just bought these two houses in Cleveland, both of these houses. One for $50,000. This is a 3-bedroom, 1-bath. I guess legally it's a 1-bath. We actually, it shows with another potentially unpermitted half-bath in there. And then this one is a 4-bedroom, 2-bath that I bought for $35,000. It looks like they haven't updated the public records on that quite yet on Zillow, so it doesn't show up. But you can see on here, this is me. This $50,000 on April 4th. That's me. So the goal with this property is pretty interesting, pretty ambitious. So right now it is a 3-bed, 2-bath. Okay. What we are going to do is we are going to chop up the floor plan a little bit and also refinish the attic. It's going to turn that into a 5-bed, 2-bath. And we may or may not fully permit and legalize the 2nd bath. Permitting bathrooms takes a really long time, and I just don't like doing that. And it's a lot more time and money than it's worth. So, obviously we'll just kind of play it by ear as we go. But okay, so 5-bed, 2-bath. And there's 2 reasons why we're doing this. When a professional appraiser looks at a house, they are really looking pretty heavily at how many bedrooms it has. The biggest reason for that is because the number of bedrooms directly impacts the capacity of the house, right? Like with a 5-bedroom house, you can fit a, family with 1 to 4 kids. You fit a lot more people into a 5-bedroom house. And so as long as it meets certain minimum standards of the square footage and has all the kind of the correct amenities and everything, the bank's going to look at that and say, yeah, awesome, that's worth lots of money. We know that if we have to foreclose on this, we're going to be able to get our money back. So that makes us happy. But also, let's talk about Section 8. Section 8 is a federally funded program that is applied on a county level that provides additional rent assistance to low-income households. There are also other nonprofits or at least non-government entities that are that work in a municipal or state level that also do stuff that's very similar to what Section 8 does. And we are working with one that specializes just in Cleveland. And so they are a lot smaller, nimbler, more specialized at what they do. And the results so far have been a lot better working with them than trying to work with Section 8, which is just like a massive program. To kind of put into perspective, it takes probably about 3 or 4 months to place a tenant in Section 8. And right now, the city program we're working with in Cleveland can place a tenant in about 3 weeks. And they actually have a wait list of small families that have been waiting for months or years for affordable housing. And we're going to be providing that to them. So, this is really just such, like, morally and ethically, it feels a lot better doing a project like this than doing one where you're either a slumlord or, over gentrifying a neighborhood and making the whole neighborhood unaffordable. So from the bank's perspective, this is what's great. Whenever you do a program like this, it's not the individual tenant that's on the lease. It is the government entity. Okay? When the government entity is on the lease, they're paying it. The bank now sees it as being super low risk. From their perspective, like, the state of Ohio or the city of Cleveland is not going to default on this lease. And so, the banks love this. So long story short, where I only got 50% loan to value, Dulce, on her single family residence flips, or BRRRR, she was getting 80%, which is what we want. And that lender actually said that, if you keep this up, and you have a good track record, and you partner with somebody that has that brings in, more investors and has an excellent credit score, we could even do 90%. My financial pro formas are not going to take 90 into account. I'm going to assume it's 80, but our goal is to get to that 90% LTV rate, because honestly, that's just going to like turbocharge this entire business plan. It's very negligible. It's very, very negligible. I mean, I think there's a certain amount of square footage under which, this just isn't going to make sense. Like if this was only a 800 square foot house, and and it's 8 bedrooms, like that's going to raise eyebrows, right? But so we're going to be really focusing on just situations where there are comps that support what we're doing. At the end of the day, one of the things that I realized is I got the real estate side of things down in terms of like how to do the renovations and how to make sure that everything was would look good and rent high and all that. But because I wasn't really a master yet of how the banks see the world, it really hamstrung me in terms of my ability to execute on the BRRRR model. Like now I realize that if you want to succeed at BRRRR, you need to not just be good at real estate and construction and and renting and all that stuff like that. You also have to really understand government programs and exactly like the fine details of how appraisals work, and then finally, really understand what all your options are in terms of banking. And you got to be working with the right loan broker to help shop your deal around to multiple different banks to get you the best deals. And like I said, we actually got this one for $35,000. I mean, $35,000. Yeah. I mean, it's so hard to lose money on a $35,000 investment. Like we could literally, we can empty all the trash out of it, which I think we already did that. I think this is the one where we already, demoed out the inside and like cleaned it all up and hauled all the trash away. And it shows beautifully now, at least like to a professional fix and flipper. I mean, we could sell this for $45K tomorrow, and have made a little tiny profit on it. But what we're gonna do is, let's go back to this one real quick. Let me pull up, because basically what we're gonna do with this is once we add those couple extra bedrooms in here, the ARV at that point is actually going to be $160,000. And we can support that with a couple comps in the same neighborhood. $160,000. Yeah, there's another property at 994 Parkwood Drive, appraised at $162,000. That's right around the corner from this. And this isn't one of those like comps where we're trying to hide anything or pull anything by oh, it's on the other side of the big street, it's on the other side of the freeway, and look, it's worth twice as much. No, this is in the same neighborhood. And $160,000 when you add those extra 2 bedrooms and dress it up, right? Like we're that's not going to be like luxury finishes, but we're gonna it's gonna be a nice house. And the best part is that the way Section 8 and the city program look at things, they're going to look at those. Let me change this view back. They're going to look at these properties. They're going to say, you know what? If we can fit a little, family with 3 kids in here, we're going to pay you at least $1,800 a month. Okay, $1,800 a month. Potentially over $2,000, but again, my model is just going to be based on $1,800 a month. With just a total of, for this project, we bought it for $50K. We're going to put $45K into it. Okay, so for $95K total, we are going to have an ARV 160K. And we're going to be making that much rent. This obviously, far this nearly doubles the 1% rule. Okay, and it even when you look at the cap rate, the cap rate is excellent. I mean, like all these deals we're looking at between a 10 to 15% cap rate. I mean that's just bananas. And you might be asking, well, with Section 8, sometimes you get these really bad tenants who come in and just totally trash a property. Well, this Cleveland-based program, they have these families, and generally families are better than like individual people renting just like small apartments. These the way this program works, you apply for it and you're in it for life. Unless you cause any problems for any of the landlords, you get kicked out of the program. And so these people who have their rent 100% paid for have a lot of incentive to treat the houses well and to just be good tenants, because they don't want to be kicked out of this program that is giving them a 5-bedroom house for free. Let's talk a little bit more specifically about the actual investment opportunity here. So, long story short, after looking at this and talking to Dulce, getting to know her better, and really understanding all these numbers, I started really realizing, wow, like there is a huge opportunity here. Like this isn't just, oh, hey, let's fix and flip a few houses this year. I mean, this could be something where, like I said, it's one of the best investments I've ever seen in real estate. So let's actually formalize this into what's called a syndication. It's basically pooling a bunch of money together into a formal fund, and actually do this on a larger scale. Because I've said for a while, if I have one big regret from 2021, it's that I didn't buy 20 houses right away. I bought 2 duplexes, and then I helped, friends and family to buy 2 more duplexes, and then, just kind of held off for a while until I saw how things worked out. And, little could I have guessed that at the time that, prices would start to skyrocket. The neighborhoods that I invested in would actually become a lot cooler, a lot faster than even I anticipated. and now, you know, they're in, I don't know, one of the most expensive neighborhoods in Cleveland, and I've basically made it impossible for myself to continue doing what I was doing 2 years ago. So anyway, I promised myself I wouldn't make the same mistake again. As soon as I see a new opportunity, I'm going to blow it up. So what we're going to do is we are going to raise $500,000. And with that, we're going to buy 6 houses. Now, 2 of those houses I already bought. And so, you know, so we only need 4 more. The first 2 properties, so 715 East 109 and the 15013 Elm, are our first 2 deals. You can see how those numbers are working out for those based on the estimates that we've gotten so far and some of our projections. And then, you know, basically I have added 4 additional deals on here that, kind of based on my experience and knowledge of the region, you know, should be achievable. Each of those, I'm assuming, is going to be pretty similar in terms of being like a 3 or 4 bedroom house that we're going to be able to pick up for between $40,000 to $60,000. I'm going to go for a more conservative ARV of $140,000 when we're done. And I'm hoping that the renovations for these, we're going to try to target projects where the renovation value is only going to be about $30,000, though, you know, end up being a little bit more. And, you know, as you can see all along here, our profit on just cash out refinancing is around 20%. Okay. If necessary, in order to make sure that the investors make back a reasonable amount of money, we can sell 1 or all of these and you know, be seeing substantially higher profit, you know, twice as much profit on these if we sell them instead of just refinancing them. But right now the goal is to just refinance them, because then that lets us keep the property and the income stream from it and continue reinvesting all that money from the financing. As I both sort of further develop this business model, but also see lots of other investment opportunities. Like over the course of doing this, I've actually seen a ton of small multifamily properties that are being sold at extraordinarily high cap rates. So there's a bunch of off-market properties right now. I assume what's going on is a bunch of people like me who are out-of-state investors who jumped in 2020, 2021 are now seeing that, you know, we might be sort of at the peak of value right now. And also, you know, investing from out of state is really hard. A lot of people may have gotten into too rough of a neighborhood, or you know, just had a bunch of really bad contractors, or did inspections really poorly, and so these houses turn into money pits. So, you know, I have this luxury of being able to pick up their bad investments and turn them into good investments. So anyway, so I'm seeing tons of these. Like I'm seeing like 3 or 4 of these a week that are just great opportunities for long-term buy and hold. They just don't fit this specific BRRRR model, so I'm not doing them right now. But you know, long story short, I may be setting up a new syndication very, very soon, actually, for doing these long-term buy and holds for a small multifamily property. So, you know, if that's more your speed, let me know, and I will keep you, you know, informed on when that becomes available. I do know that there are a few people who are more interested in that than they are in this. But the question is, what is DSCR? That is debt service coverage ratio. All of your expenses from the bank's perspective, you know, is your debt service. So your rent needs to cover that by 1.25, or you could also call it 125%. I put this into my spreadsheet to basically double check as I went to make sure that the debt service coverage ratio was always, you know, well above this number. Obviously, in this business model, I mean, our debt service coverage ratio is like 200%. It's like, you know, it's just like, just bonkers, like so much higher than what any rational bank would want. In today's world, we're actually seeing debt service coverage ratios as low as just 1. You know, as long as your rent can cover your mortgage, they'll do it. You know, one of the things that people don't really understand about, I guess, the banking industry right now, the lending industry right now, is how much they're hurting from the high interest rates. You know, kind of like whenever gas prices go up, we're like, oh, you know, gas stations are making a ton of money. Actually, gas stations are losing more money because the gas they are buying to sell to you is much more expensive. And so, you know, and people are buying less gas because it's so expensive. So, you know, it's actually really causing the individual gas stations to struggle. Likewise, you know, you can think of the interest rate that's being set by the Fed, you know, like let's say that the Fed says it's like 6.5%. I mean, that means that, like, you know, if you look at it sort of, if you look at a bank as being sort of like a retailer, this is their wholesale price for the loan, and they can only mark it up so much before they sell it to you, you know, so let's say 7.25, right? And this number is so high that, like, not a lot of people are buying it, and so they're hurting. So that means that they have to get a lot more creative or a lot more flexible in how and who they give loans to, just to get people in through the door. So, you know, one thing that I said on Alex Kalisa's podcast about, you know, artists, entrepreneurs, you know, actors, musicians getting loans is it is probably the best time in modern history for someone who's self-employed to go out and get a loan, because banks are just sort of bending over backwards right now to offer as many loans to as many people as possible. And then, you know, and then bear in mind, it's like, as long as you're able to afford this number, you know, you're like, chances are you're going to be in a good situation, because whether it takes a year or a few years, that number is going to go back down. You're going to refinance, and now you're, you know, you're doing a lot better. So, again, this is Richard Wayland, owner and broker of the Imagination Brokerage. You can find us at imaginationbroker.com. And also, you know, follow me on Facebook. I post a lot of really funny little videos and posts all the time. We do have an Instagram, but I am too old and boring to really understand how Instagram works. But I do have some stuff on there that my wife posts. And, you know, thank you again so much. Take care.